Hello, my name is Yutaka Watanabe, a tax accountant. Welcome to the channel. Tax Accountant Nabe solves your money problems. Today, I'd like to talk about what is a tax haven. Now, the term tax haven is something we often hear in the news, isn't it? It has a somewhat suspicious ring to it, but today I'd like to explain in a very simple and easy to understand way what kinds of international tax rules and mechanisms are operating behind it. First, please imagine this for a moment. If you were the head of a multinational company generating enormous profits and you were thinking, is there some way to legally reduce taxes? What would you do? Perhaps the first thing that would come to mind is the idea of moving your base to a country with low taxes. This brings us to the fundamental question: what exactly is a tax haven? Literally translated, it means a tax shelter. How is it actually used? And what kind of rules are in place to prevent abuse? Let's explore this right away. So, what is the tax haven countermeasure regime? In short, it is a system designed to prevent companies from unfairly avoiding taxes by creating subsidiaries in countries or regions with low tax rates. This is not merely tax calculation rule. It is, so to speak, a powerful defensive wall built by the government against attempts to use unfair loopholes. So, what exactly does that unfair method look like? Here is how it works. A company creates a subsidiary that exists only in form in a country with an extremely low tax rate. In other words, it creates a paper company and shifts profits there, even though the head office is in Japan and the actual business is conducted mostly in Japan. Only the profits are gathered in a subsidiary located in a low tax country. That is the structure. For individuals and companies that honestly pay taxes in Japan, this feels unfair, doesn't it? That is exactly the trick behind unfair tax avoidance. Now, let's look at how the actual mechanism of combined taxation works. What clearly illustrates this strange situation is the contrast between a Japanese parent company and an overseas subsidiary with no real substance. In Japan, there is a proper office and employees are working there, but overseas, there is only a name, an empty box. This distorted structure across national borders becomes fertile ground for secretly hiding profits. So, Japan's tax system goes after this empty box through three very logical steps. Step 1. It identifies whether the overseas subsidiary truly lacks substance, such as an office or employees. Here, whether the company is effectively controlled from Japan also becomes an important criterion. Step 2. Surprisingly, the profits earned by that empty box with no substance are treated entirely as profits earned by the Japanese parent company. It may seem forceful, but it is logical, isn't it? Step 3. Those deemed profit are then combined with Japanese income and taxed properly in Japan. Even if the company thought it had successfully moved profits overseas, in the end, it cannot escape. That is how well designed this system is. However, I'd like to add one important point here. This combined taxation doesn't apply to all overseas subsidiaries. Subsidiaries that are genuinely conducting business locally are not subject to it. In other words, companies with real substance are properly protected, while only paper companies without substance are targeted. It is a very fair design. The extremely important point of this rule can be narrowed down to two. First, ensuring transparency in corporate economic activity. In other words, making it clear where and how profits are generated. Second, curbing international tax avoidance. This is not simply because governments want to collect more tax. It is an absolutely essential system for all of us because it protects an environment where everyone can compete fairly across the global economy. Incidentally, Japan's tax haven regime applies when the corporate tax rate of a foreign subsidiary falls below a certain standard known as a trigger tax error. This standard is reviewed periodically in line with international trends. Also, in response to the OECD-led BEPS project, measures against tax havens are steadily being strengthened around the world. Japan's system is also firmly positioned as part of this international trend. Now, finally, there is one question I'd like you to think about. Can the current rule alone continue to fully suppress international tax avoidance, whose methods keep evolving day by day? Companies keep trying to find new loopholes, while governments desperately try to close them. It truly is an endless game of cat and mouse, especially in today's world, where digital businesses are expanding rapidly. Companies can generate huge profit from around the world without having any physical base. As a result, there are more and more cases that cannot be fully addressed under traditional rules. The reason countries are cooperating to create new systems such as the global minimum tax is precisely because they are seriously confronting this issue head-on, which will move faster the evolution of the rules over corporate strategy. No one knows yet when will the day come when perfect fairness is achieved. Please take a moment to stop and think about that. Today, I talked about the topic, what is a tax haven? For more information about international tax matters, please visit the website of Yutaka Watanabe, Tax Accountant Office. I will continue sharing content related to money, so please subscribe to our channel. Tax Accountant Nabe solves your money problems.